Today, we are covering the episode 21, which is basically the hBits educational series webinar. The topic of today is very important. While we see that at different stage of life and different path of life, you invest into equity, you invest into different asset classes, but there is some particular subject which covers all the objective setting for a particular investor to park in. Regular income in volatile markets. There are certain trends which we see where volatile market actually come in different cycles. How does it impact and what was the kind of gain, how it has happened? So we have Mr. Samir Bhandari, our co-founder and CFO, who comes with us with a vast experience. Over to you, Samir, sir.
Thank you. Thank you. Good afternoon, everyone. And as Aabimaanyo mentioned, thank you for joining on this Thursday afternoon. Today, my purpose is around the presentation would be uh, to tell people where they should be investing. A lot depends on your risk appetite. A lot depends on your age. A lot depends on the on the cycle where you are really. Are you closer to retirement? Are you starting your career? Are you mid market in a middle part of your career? So I think that becomes very, very important. So today's webinar hopefully will throw some light around that. I'll also be talking about my experiences, how I invest my personal money, so that will also give you an idea of where you feel you could actually invest your money. And obviously, there's nothing right or wrong. Everyone has a different view. Everyone's risk appetite is different. At the end of the webinar, I'll be very happy to answer Q&As. Just as a background, let me talk a bit about the leadership team in hBits. Shiv Parekh is the founder and CEO. He's a Forbes 30 under 30. He's a Stanford undergrad, uh, and and he did his MBA from Harvard. He has been an entrepreneur for a while now. In fact, he started this company in 2019. As Abhimanyu pointed out, I'm the co-founder and CFO. Prior to this, I had 34 years of banking experience across the bulge bracket firms. So I worked with Bank of America, UBS, JP Morgan, and then Lehman slash Nomura. I was the co-chair of global market sales at Nomura across all asset classes, across fixed income and equities. And as a background, I'm an MBA from IIM Ahmedabad, 1989. And prior to that, I did my chartered accountancy. Next slide, please.
Before moving to the next slide, Samir, as an instance for everyone, I guess when you joined Lehman, right?
Yes.
Within 2 months, I guess there was uh, that particular zone where it fell, and Nomura picked it up, and you're part of Nomura. So it could be a part of your experience as well, how your fixed income or investments, or probably your attitude took care of that particular path for you.
Absolutely. So I'll Abhimanyu also talk about that when I'm talking about my experiences around investing. Could we go to the next slide? Yeah. A bit around Abhimanyu. Abhimanyu works with me very closely. He's the head of sales for us. He's got 25 years of experience in banking. He's worked with banks like HDFC, DBS, Kotak, and HSBC. Uh, Abhimanyu was one of the first employees of hBits. He's completed close to 6 years with us, and he's been an integral part of our management team. Next slide, please. Um, so let me talk a bit around how the markets have behaved, and I'll go all the way back to 2008. 2008, as we know, was a global financial crisis. that, and I remember it very distinctly because I was in Lehman Brothers at that point in time, when Lehman collapsed. And there was obviously chaos then, right? Obviously, in India, the Sensex fell close to 63%. Um, and in the U.S. markets, again, there was chaos. The Fed had to come and bail out people. A lot of the investment banks were actually bailed out by the Fed. The one thing was very, very clear: equities fell, but bonds actually rallied. Government securities in the US and any kind of high grade bond actually rallied. Fixed income actually did reasonably well, though credit spreads obviously widened out a lot, but actually interest rates came off a lot. The Fed injected a lot of liquidity into the markets, and good bonds kept paying. So the coupons you continue to get, as long as the company had not defaulted. Uh, Fast forward to 2020. This is around the COVID time. As we all know, COVID had a big impact on global markets. The US markets fell quite a bit. The Sensex in India fell 38%. But again, if you see fixed income, as long as you were in the right space, i.e., good companies or gilt funds, bonds, fixed deposits, you continue to receive your coupon. Though if you had equities, obviously the equities portfolio fell quite a bit, since the Sensex has fallen 38%. Uh, Similarly, if you fast forward now to 2022, the start of the Russia-Ukraine war, inflation went up because of supply constraints. Sensex fell 17%. Again, fixed income instruments, uh, not on a mark-to-market basis, but on a coupon-paying basis, continue to pay coupons. So what it really means very clearly is, instruments which are more volatile, especially equities, uh, can actually go down quite a bit. And similarly, we are seeing, as recent as now, when the FPR has been pulling out, equity markets again have been extremely volatile, whereas fixed income markets have not been that volatile. Uh, so the overall thesis here is having some kind of fixed income in your portfolio as a percentage is always very, very helpful. Now, let me take a step back and say, so what percentage of fixed income should you really have? If you're starting your career, so suppose you are a 23-year-old person, you're starting your career, I would say most of your money should be in equities. And the reason being, you started your career, you're earning a salary income, uh, and you are looking for high growth, and you are happy to take a lot of risk. So your risk appetite is very high. So I would say equities, you could go as high as 90% or even 100% in equities. Um, if you're in the middle part of your career, I would say when you are in your late 30s and 40s, I would say the portfolio should be anything between 60-40, 70-30 in favor of equities. Again, why there? Because your career is probably doing well. You can take a reasonable amount of risk, but of course, you want some income also uh, to lend stability to your portfolio in terms of volatility. So I would say 60-40, 70-30 should be your mix. Once you move to slightly higher, say if you are closer to 55, 60 and above, and you're getting closer to retirement, I would say majority portion of your portfolio should be in fixed income. Now, depending on your risk appetite, I mean, you could decide that, okay, I'll still want 40% in equities and 60% in fixed income. But I would say as you as you move closer to retirement, you want to make sure that your income is steady. You get it on a regular basis to support your lifestyle. So you could go as high as 75% or 80% in fixed income, and a small portion in equities to give you growth. Now, all this obviously also depends on your risk appetite. You could be an older person, and your risk appetite is reasonably high, so you want a larger allocation to equities. Similarly, if your risk appetite is very low, you could move totally towards fixed income. And when I talk about fixed income, it can be bonds, it can be fixed deposits, it can be pretty much across REITs, SM REITs now, which is a new instrument coming through. So it can be pretty much anything. But do think about this in terms of where you are in your life, how much you're earning, what kind of stability do you want, and that becomes extremely important. So based on that and keeping that in mind, uh, we in this presentation we'll talk about different instruments where you can actually invest, compare them, and then you can take a calculated decision where actually to invest in. Next slide, please. And this is a very interesting slide because important to note why growth alone isn't enough. I mean, let's talk about the first part where we talk about the real return problem. Now, if you invest in fixed deposits, suppose a fixed deposit gives you 7%, and if you're in a high tax bracket, say 30%, you get 4.9% post tax, whereas inflation is higher than that. So the real return actually is much lower. So you need to make sure that at least your real return after inflation is definitely positive. Otherwise, your capital is actually depreciating effectively, right? Because your real returns are negative, and that becomes very important to bear in mind. And that's why the instrument you invest in is extremely important. The second problem is the equity timing problem, right? I mean, I can tell you over long periods of time, the large cap index gives you around 13%. So, which is extremely good because not many asset classes give you 13% on a consistent basis. But the bigger issue here is this is an asset class which is volatile. So, God forbid, if you need money on a very urgent basis today, and the equity markets are down, say 30%, so you will have to liquidate it because if you don't have some other kind of portfolio which can compensate you. So this is one thing you have to keep in mind while investing. And hence, coming to the third part, it becomes very important to have some kind of a floor, or what we call an income floor, where if there's a need for immediate cash, it's far easier to either liquidate that instrument or be in a position where you are earning actually income on a regular basis. Next slide, please. So this is what we call the income floor. The income flow is part of your portfolio that pays out a fixed, predictable amount every quarter. It could be every quarter, it could be every month, it could be every 6 months, and regardless of what the stock market does, right? It's not a product; it's a structure. And obviously, there are different products around it, right? It can be a fixed deposit, it can be a bond, it can be a REIT, it can be a listed REIT, it can be a SM REIT, and there are various kind of instruments there. Now, this again is important, and as I spoke in my earlier, that what's very important is what is the percentage of your amount you should be putting into this so as to get an income floor. As you get older, you need to make sure that a larger portion goes into the income floor. When you're younger, you don't need that safety net. You are happy to take a lot more risk. and you're happy to invest in instruments which do not have an income flow, and the case in point being equities, right? Or to some extent, real estate was also as an asset class. Um, so I think that becomes very, very important. And as we mentioned in the slide, the income flow is not the conservative part of your portfolio. It's a part that actually uh, makes the aggressive part possible, because you know there is a safety net for you in case you need that money, and that I think is extremely, extremely important. So do remember that this income flow is important. It's important to make sure that you allocate a certain amount, and whatever that amount could be, right? It could be 60% of your portfolio, it could be 80% of your portfolio, it could be 20% of your portfolio. But do think about it and then decide that how much do you actually need. Especially for people who are retiring or getting close to retirement, the income floor becomes very, very important. Of course, they'll have the pension which they get, but other than that, if they want to have a certain quality of lifestyle, this becomes extremely, extremely important. And having all your portfolio in a very volatile product obviously is not the right thing to do. Next slide, please. So this is just, I won't go through details. This is just a slide which talks about investor A, where there is no income floor. Obviously, it's all in equities. Uh, there's no hardly any yield on the portfolio. And then the investor B, who has an income floor, and the income floor could be in, it could be in SM REITs, it could be in bonds, it could be in fixed deposits. And here, basically, what we've spoken about in this slide is how volatility is not your friend, especially when you don't have an income floor. And that is very, very important, and it's one of the most important things to keep in mind, that volatility, when there is volatility in a product, you don't have friends when you need them, i.e., uh, it does not pay you anything, and this really bites you, especially when you need money the most, and you will have to liquidate the product at the point in time, at the lowest point in time, because you will not have, if you don't have an income flow. So just, I mean, we can share these slides with you separately, but this is just a slide comparing investor A versus investor B, one who has an income floor and one investor who does not. Next slide, please. This again is a very important slide. Talks about various instruments. We've also included SM REIT because we are in the process of launching our first SM REIT. I know it's taken a bit of time, but I think the product we are going to launch is going to be an extremely good product. Then you have different kinds of instruments, and we've just done a comparison. We've got SM REIT, we've got the listed REITs, we've got the PSU bonds, we've got arbitrage funds, we've got corporate bonds, debt mutual funds, and fixed deposits. And here we've really spoken about only the yield. We haven't really spoken about capital appreciation, because in SM REIT and listed REIT, you also get a reasonable amount of capital appreciation. Typically, capital appreciation is 5 to 6% per annum, but we haven't really spoken about that. We've just spoken about yield. So as you can see, the yields are much higher in SM REIT. Of course, corporate bonds are also similar to some extent, it's 7 to 8%. But this gives you a real good comparison of all the instruments in the market which you can actually invest in. We've also spoken about risk. The risk in SM REIT is low to moderate. In fact, the only risk really is the tenancy risk, because typically the quality of the tenant we are very, very particular about. But one risk, of course, is if the tenant leaves and it takes a bit of time to get a new tenant, then the property is vacant. And that at that point in time, you may not get rental. Similarly, that's also the case for listed REITs. where tenants can leave, and then it takes a bit of time. But other than that, there's not much real risk as such, because these are backed by real world assets, right? These are backed by actual properties which you can see and feel. So that's very important. Taxability, reasonably, they're all pretty much similar. There's long term and short term capital gain. Liquidity, in SM REITs, they are exchange listed, and we'll work towards giving liquidity to these instruments also. Most of these instruments have a reasonable amount of liquidity, so you can liquidate actually instantly. In case of corporate bonds, it might take a bit of time, or in case of fixed deposits, you may have to actually break the deposit. But other than that, liquidity is reasonably good. Obviously, the most important part, I think, is inflation. Inflation you should take at least 5%. So any instrument you actually invest in should give you at least a positive real rate of return. So these are the different instruments available in the market. Of course, there are other instruments like AIF, structured credit funds, but there the ticket sizes are much larger, and they have basically lock-in periods of 5 years or 6 years or 7 years. So that's not the most suited if you really want liquidity, which is what we are really looking for. So as an instrument, I think if you're looking for income, or if you're looking for an income floor, all these instruments can be considered. And you're also getting a new instrument, SM REIT, which has been introduced into the market to do a comparison against all the other instruments. If you want to compare against equities, you should compare this against large cap equities. Don't compare it to mid caps, because mid caps are very volatile. Equity markets in general are also volatile. So if you're comparing it to equities, you should compare it only to large cap equities. But this table is extremely good. I mean, it gives you very good knowledge around different kinds of instruments and where you should actually be investing. Next slide, please. So just as a summary, what I would say is, look at where you are in life, i.e., have you started your career? Are you in the middle part of your career, or you are in the fag end of your career? That's one. Secondly, every person has a different risk appetite. I may have a risk appetite which is much larger than others. Based on your risk appetite, how much are you willing to lose your capital? You have to decide which product you want to actually invest in. Thirdly, having an income floor, I think, is good. I think it's important. So having a certain portion in fixed income type of instrument, I think, is one of the best things to do. My suggestion is, as I mentioned, if you're younger, even if it's 100% equities is fine. But as you become older, I would say you should go from anything between 30% as an income flow all the way to 80-90% also. If you're 60-65, you can have a very small portion in growth equity, which is good because which enhances your portfolio. But I would still say a large portion of your portfolio should be in fixed income or income giving products. So let me stop there. Let me pass it on to Aabimaanyo, and then we'll be able to take Q&A.
Yeah, so I'll just add in a point what just Samir mentioned. He mentioned about that his risk appetite is high. Well, that backs up with a great knowledge. So I guess along with that, how you should invest in knowledge, understanding the product as well. How I'm just giving an example. Samir spends approximately 3 to 4 hour of his time during the weekend read about things, and of course, every day at least like a half an hour, he read about. So his strength, or I should say, his things that yes, he's read about it, he's bullish about it, he knows it, so he's investing into it. That's why the risk appetite. So you should actually go as per your own decisions on your own acumen and not as per how general herd mentality goes. So that's so. I'll just
No,
move.
that's Abhimanyu. That's a great point.
Mhm.
I think it's very important to invest in knowledge of
Right.
these products, which only comes through reading, listening to people. I think that's very very important. Based on that, you can then decide your risk appetite.
Right, right, Chief. So I'll just move to the questions. I don't think so. There are many questions. Uh, First question is from Abhishek Patnaik. Is there any data that SM REIT and listed REITs appreciate 5 to 6% per annum?
So listed REIT, definitely there is data. I mean, some of the REITs have been listed for a while. And if you go through it, I think, and they've done extremely well. So yes, listed REIT data is there. SM REIT data is not there because they've just started getting listed. But why I think they appreciate 5 to 6%, because typically we get rental escalation every year by at least 4.5 to 5%. And commercial properties work on cap rates. So assuming the cap rate remains the same, even the same, you will get at least 5% appreciation. So the way you should look at it is look at commercial buildings across different cities and see how they've actually how prices have escalated, and I think you will get 5 to 6%. In some cases, even more. In say some of the places like Bangalore, they've actually gone up by 15 to 20% also.
Next question is from Mr. Mahesh Khandelwal. Listed SM REITs are not doing great, if I'm not wrong.
So, firstly, Mahesh, the listing has just happened. There are only two or three listed SM REITs. Uh, Now, SM REITs prices don't change on a day-to-day basis, because end of the day, the underlying is a real world asset. It's a property, right? Property prices, I mean, don't go up every day, right? I mean, over long periods of time, we've seen them going up. A lot of these SM REITs have just been listed. In fact, one has just got listed a couple of months back. So one got listed 5 6 months back. One is a year back. So the pricing is fairly flat. But I think as time passes, you will see these SM REIT prices also going up.
Another question is from Mr. Aditya Loya. What care is being taken regarding valuation of an asset at the time of purchase? If you can let down certain legal checks also that are taken.
Sure, that's a great question. So on valuation, typically we have an independent valuer of the asset, and this is typically an IPC, whether it's Cushman Wakefield or JLL. These are the people who actually value it independently. Obviously, we have our own team which will value it and decide at what price do we want to buy the asset. So we've been doing this for a while, so obviously that's very important. The legal checks, it goes to a thorough legal checks. We typically use CAM, which is Cyril Amarchand Mangaldas, which does a technical due diligence, which does a property due diligence. A lot of due diligence is done, and SEBI insists that the due diligence is done first before you can even launch the SM REIT. So all the checks have to be, all the boxes have to be ticked. Only then the SM REIT can be launched, and the lawyers who are used are very reputed lawyers.
Question from Mr. Rajubi. So my investment with the company, how do you plan to at least go for the capital?
So the capital is reasonably preserved, right? That's never a problem. Investment is not bad as such. As I always said, the risk is that suppose a tenant leaves, and it takes a bit of time to get a new tenant. Obviously, we as a company will continue to look for a tenant, and we have been aggressively looking for that. So it's not gone bad as such. Only you're not receiving rentals till the time we get a new tenant. Unlike if you compare it to equities, right? I mean, a lot of people don't talk about it, but equities have run really badly and people have lost the principal. In this case, the capital is actually preserved.
Indeed, the capital has actually gone up because the underlying money, property appreciation has actually happened in most of the properties which we have. Uh, Abhishek Patnaik, what are the risks associated with SM REIT versus listed REITs?
So I would say the differences are two. One is, of course, tenant leaving, which is there in both the cases. In the listed REIT, typically because it's very diversified, uh, the risk is much less because they may have 50 tenants. So that is there. Whereas in SM REITs, typically we'll have one or two tenants. And I would say that's really the only real risk, tenant leaving and we taking a bit of time to find the tenant. And that's one of the reasons we try and assess before buying the property whether the tenant will stay or not. Now, obviously, it's not perfect. I mean, as you know, if you own residential property, if you own commercial property, the tenant has a right to leave for whatever reason. So that I would say is one of the main real risks as such. In a listed REIT, obviously, because it's very diversified, they have sometimes 50 or 100 tenants, so that risk is lower. But there, the risk is because a lot of properties are under construction. I think 20% of the portfolio of listed REIT is under construction, and they also typically borrow against the listed REIT. So if interest rates go up in a listed REIT, then that affects the price of the listed REIT. We in SM REITs don't plan to borrow at all.
Sorry. Question from Mr. Devendra Tyagi. Is F&O trading allowed in US? If yes, how can we do it? By which reliable platform? Please guide.
So futures and options is very liquid in the US. So there's IBKR platform, which is one of the best in equities in the US. You can actually use that. I would recommend IBKR for any kind of options trading.
Question from Tanisha Jaiswal. How does SEBI actually regulate SM REITs? What protections do I have as a small investor that I wouldn't have if I bought a commercial property directly?
So SEBI, we are under direct supervision of SEBI. So SEBI will do inspections when we file. We have to file an IPO document before listing an SM REIT, what we call the DRHP, the draft red herring. Um, so we are under them, right? So they will regulate us as a regulator, as RBI regulates the banks. Uh, they also have protection for small investors, where if you have a complaint or if you have anything, you can actually write to SEBI on their portal, uh, any kind of thing, and we as asset managers are forced to answer those queries. Uh, if you buy a commercial property directly, right? Say a 5 crore or a 10 crore property, there's no regulation, right? I mean, for you'll have to manage the tenant. You have to make sure that the tenant pays you on time. If he doesn't pay you and if he refuses to pay, you have to take legal charge, stuff like that. Whereas in our case, firstly, we are professional asset managers, so we do it on an institutional way. Plus, SEBI supervises us, right? So when we file the red herring DRHP, they make sure that the document is for complete. They make sure that anything which is missing is actually addressed. They make sure that the due diligence of the property, everything has been done. When you buy a commercial property, a lot of the things which we actually don't know. So that's the risk we take when we buy directly. Yeah. I hope that answers the question, Tanisha.
Question from Mr. Deepak Vaswani. REITs investment for getting income would need very high capital.
Not really, because in SM REITs, the investment is 10 lakhs and it's expected to go down to 2 lakhs. That's what I believe SEBI is looking at. Whereas in listed REITs, not SM REITs, but normal REITs, I think the investment amount is 3,000 or 5,000 rupees. Obviously, depending on the amount of investment, income, appropriate income you'll get, right? If you invest 1 crore, obviously your income is going to be much higher if you invest only 10 lakhs. So that's a given, and that's a case for any kind of investment you make.
Question from Mr. Greg Reddy. Could you compare it with InvITs?
Yes, in a way you can compare it with InvITs, but InvITs are more infrastructure, they're road investments, and the capital appreciation in InvITs is a lot less. But the returns typically are higher. So instead of getting 7-8%, you might get 10-11%, but you may not get any capital appreciation.
Question from Mr. Raghavendra Elkar. What is the timeline for an
hBits to launch its new SM REIT? So we are looking at Raghavendra, September, October. We are just doing the due diligence of 2 properties, and that's going on. Typically, due diligence takes anything between 45 to 60 days. So we are in the process of doing that.
Mr. Arabia. How will I get my expected IRR? Rental receipts have stopped and you're the property as appreciated, then why don't you sell off? Well, for this, Mr. Raju, you can reach out to me directly and I can actually take you in detail for all the particular question and answers on what we're working on this particular asset. Question from Mr. Atul Maurya. How to exit the fund apart from secondary market sale as volume in secondary market is negligible?
So Atul, what we are trying to do is we plan to make markets. So we do want to market make, and we are talking to SEBI around that. SEBI has been actually quite supportive on market making. So if the market making is there, even if the volume is negligible, you will be able to exit your share.
Question by Mr. Atul Maurya. How to exit the fund apart the second? This is already same thing.
I just answered that.
Devendra Tyagi, thanks. Aditya Loya, when do you intend to launch the SM REIT? Also, which city is under considering for purchase of asset?
So purchase of asset, we consider pretty much all the major cities. So we can look at pretty much any city. When do we plan to launch? We probably launch in September, October. Like I said, we are doing the due diligence of 2 properties.
If I want to get yield of 1 lakh per month, how much investment is needed? So you just need to do a reverse calculation when the draft or the prospectus of the investment is there. And we will as well put some kind of a calculator on our website. You can always do reverse calculation looking at the number of, which is actually the yield mentioned in the prospectus. A monthly calculator you can have. But just for information, it's going to be a quarterly payout.
Yeah, in this case, it's going to be quarterly, and just coming back, 1 lakh per month effectively means you need 12 lakhs. So you will probably have to put around 1 crore 25 to 1 crore 30 lakhs.
Correct.
To get this kind of income.
Yes. What about income tax?
So income tax on rental. Every property will be different. If it's a sale and lease back, there is a certain tax. If there is not sale and lease back, then the tax could be different. So that will be every rental. The tax could be different. Long-term capital gain is for selling your units, which is at 12.5%.
Similar question from Mr. Mahesh Khandelwal. Major source of income would be return of capital in SM REIT. Is this correct? What would be the tax implication?
That's what, Mahesh, we would like to do. We would like to reduce the tax by showing it as return of capital. In some cases, it's allowed. In some cases, it may not be allowed. Like for example, a sale and lease back, you also have to look at the value of the asset in the books of the seller. So there are a lot of nuances which you also have to look at. But that's going to be we will try to reduce the tax liability of the investor as much as possible.
Similar question, and I guess that's how the
Yeah.
series of thought happens together. What about income tax? So we have already covered this. Question from Shwetang Chandra: how exit can be done?
So these, Shwetank, will be listed on either the NSE or the BSE. So you can just sell it as you would sell a share. You'll have a demat account, so you could just go to your broker and sell it, or you could do online. So it's very, very easy, like any equity.
Question from Sheshro Tejne: like equity, are REITs or InvITs are actively traded at stock exchange?
So, Sheshav, they're not actively traded because the price of REITs and InvITs doesn't really change, right? And as I mentioned, they're backed by real estate. And real estate, as you know, does not change on a day-to-day basis. Equity changes on a day-to-day basis because of sentiment. It can be FPIs investing in that. It could be the performance of a company. In this case, it's very, very different. So they're not actively traded, but are they traded on the exchange? Yes, they are actively traded.
Before we finish the session, this was the last question. I'll request everyone who is participant over here to scan this QR code and be a part of the hBits community. We send in a lot of analysis, data points, and updates about commercial real estate and other practices followed by wealth management. So it becomes a key important part of this particular thing. We have added a lot of tools in terms to we do surveys. We give a lot of glimpse on how the other what different markets are playing, what is the absorption and consumption, what is a basic factor of investment into this particular thing. So this becomes a very important channel, as I earlier mentioned, knowledge. So please join this one to gain some knowledge. We'll be really happy to have this, and as well have to have some critical updates. I'll just wait on this particular screen for 30 seconds and please join this.
And I also wanted to take this opportunity to thank everyone for joining. It's your valuable time, and we do appreciate you joining, taking the time out on a Thursday afternoon and joining this webinar. Thank you so much. We look forward to doing a lot of these educational webinars. Plus, if you have any specific questions, do write to Aabimaanyo, or you could write to me, and we'll be more than happy to answer these questions. Whether these are related to SM REIT, whether this is related to fixed income, whether this is related to equities, more than happy to answer all your questions. Thank you so much.
Thank you very much, everyone, and have a great weekend ahead. Thank you, Samir.
Thank you, Aabimaanyo.
Thank you very much. Bye bye.